Management fee and performance fees are the main income source of a fund. I have a fund compensation mini course that went through all the details of management fee and performance fee calculations. I don't plan to go through a lot of details in this course since our focus is fund accounting. For this fund, we use the most basic scenarios. For management fees, we are going to base on 2% of the committed capital. Private equity funds typically charge two types of fees, management fees and performance fees, or carried interest. These fees compensate fund managers for managing the fund and incentive them to generate strong returns. The management fee in a private equity fund is a fee charged by the fund manager to cover the operating expenses and managing the fund, such as salaries, overhead, and administrative costs. This fee is typically expressed as a percentage of the committed capital, invested capital, or net asset value, depending on the fund agreement. The fees could be based on fixed rate or tier-based. The fixed rate could be based on committed capital or invested capital or net asset value. Our model here is 2% based on fixed committed capital. And for tier-based, commonly used in private equity funds to adjust the fee rate based on the amount of capital raised or deployed at a different threshold. I don't plan to go through the details here. If you want to dive into the calculations, please go to the fund compensation mini course. I will add a link in the description section below. Fund may change the management fee structure during different life cycle of a fund. In initial years, fees are often based on committed capital during the fund's investment period. In the later years, after the investment period, the fee may switch to being calculated on invested capital or now. Again, this is covered in my mini course. We don't go through the details for now. Our focus will be here, how to book the management fees, since this is the accounting model. In our business plan, we have committed capital $15 million, and we set up this fee rate 2%. As a result, our management fee is this commitment times the 2% divided by 12. This is our monthly management fee that will be accrued every month and paid each quarter. We will debit the management fee expenses and credit accrued management fee every month. By the end of each quarter, we will factor the accrued management fee and credit the cash and the cash equivalent. This will reflect on the income statement. We would have management fee $75,000 year to date as of the first quarter. That is $25,000 times 3. Then this is the year to date as of 6/30, the management fee amount. Right now, we set up the $15 million commitment. If we change the commitment to be $25 million, this fees will be changed too. If we change the rate to be 3%, the amount will be changed as well. So this is how we set up the model. In terms of performance fee or carried interest, this is way more complicated than management fee. Again, we just go through the very basic, simple case here in this example. For more details, please go through the fund compensation mini course. That one will help you understand the performance fee and the carried interest, the concept and the calculation much better if you have any questions. So performance fee, also known as carried interest, is a significant component of compensation in funds. They are designed to reward fund managers for generating superior return for investors. So carried interest is a share of the profit that the fund's general partner receives, which is in addition to their management fees. It is intended to align the interests of the GP with those of the LPs. So how it works? There are 3 items: profit sharing, hurdle rate, and catch-up provision. So the GP typically receives a percentage of the fund's profit, usually 20% after the fund has returned the initial capital plus a preferred return, also known as a hurdle rate to the LPs. For hurdle rate, this is a minimum return that LPs must receive before the GP can start earning carried interest. Common hurdle rates are between 6 and 8% or even 9%. Catch-up provision. After the LPs receive their preferred return, there might be a catch-up provision where the GP receives a higher share of profit until they catch up to the agreed percentage of profit. This helps balance the distributions between LP and GPs. For the calculation, If a fund generates $100 million in profits and has a hurdle rate of 8%, the LP must first receive the preferred return. If the fund surpasses this hurdle, the GP would then receive 20% of the remaining profit as carried interest. Returns and fees. The actual carried interest is typically calculated after deducting management fees and other expenses. Again, this is just go through the basic concept. And I have 9 models in my fund compensation structures to go through different scenarios. For tax treatment, in many jurisdictions, carried interest is taxed at capital gains rates rather than ordinary income rate, which can be beneficial for GPs but controversial from a tax policy perspective. So always consult tax advisors for this part of tax treatment. For this particular situation here, our performance fee expenses would be $838,000. Let me bring our model to show you how we got this result. In my fund compensation mini course, if you go through the performance fee hard hurdle with high watermark, you would see this calculation here. We set up the 50 million contribution, and with the profit we have 5.693770. This is the number we got from our income statement. So this is our 5.693770. This is the number we got as the year-end profit. Based on the asset under management, we calculate the management fee by the end of the year that is 2% of the commit capital. Then we have our NAV here, and we have our hurdle based on 8%, and we have our performance base, and this is our performance fee. Anyway, for more details and the calculation, you will need to go to the mini course. We just use a very simple case here. The performance fee is 20%. So our base is our net profit after deduct the management fee and the hurdle. And we have our NAV by the end of the year. Then we keep going every single year. So right now we don't go through many years, and we will have our next model to expand the years with more scenarios. So this is our performance fee and how it impacts the income statement. In this fund, I just pick up a base case scenario to calculate the carried interest performance fee. There are many different situations, and I have 9 models. I could just pick up any model for these numbers. Right now, I pick up a very simple model to get these numbers. As a result, this will have 2 types of financials. Because our fee is charged based on the fund performance, before we calculate the fee, we have an income statement like this, these columns. And after the fee, the fund will have a new balance. That is why we have a after fee income statement, and we have a after fee balance sheet. The difference between these 2 statements is we added this performance fee in this session. As a result, our net income is $4.8 million. Our balance sheet would be changed as well. This is a reconciled table down below to calculate the performance fee in a simple way. We have the contribution, P&L. So first of all, we calculate our GAAP. GAAP is the contribution plus the P&L and plus the 2% management fee. Then we have our hurdle here, 8%. And this is our performance base. This is 20% of the performance base. So this is the number we calculated from our other model as well. And in our cash flow, set up this as a payable. In our investor allocation, we have our performance fee allocation here. GP, we will charge 1%, and the rest of them will be allocated accordingly based on the ownership. So these would be net income after the fees in the income statement. And in our capital account statement, the GP will receive all the fees as a fund manager. So this is the GP's ending capital after getting all the fees. And this is the LP's allocation. So this is what ending capital look like for each of the investors after the fees. And after we book the entries, there will be a distribution. That will happen next year. Right now, we set up this performance fee as payable. And next year, this amount will be paid to the GP, and there will be distribution entries. Again, I have all these details in my fund compensation mini course.